Hello students, we are going to start the next topic of accountancy of class 11, that is important accounting terms. In the last video we have covered what an accounting process is. In this video we'll cover the important accounting terms. As we all know that there are certain accounting terms which are used widely in the business world, right? But before recording the transaction in the books, it is very necessary to understand the terms which are widely used in accounting process, right? In this video, we'll cover those terms. On the screen, you can see that there are 34 terms that we have to cover and there are many more, right? But in this video, we are going to cover only 19 terms because as per the CBSE curriculum, only 19 terms are given in your syllabus that you need to cover as an important accounting term. So let's start with the business transactions. What is business transaction? Basically, the transaction is an event. A transaction is an economic activity which involve some value between two or more entities, right? There must be two entities. There must be involvement of two persons, right? So that an accounting transaction can took place, right? So business transactions can be credit transaction, can be cash transaction. It can be internal transaction as well as internal transaction, external transaction, right? Some examples of the business transaction are like introduction of the capital by the owner, sale of goods, purchase of goods, cash received from the customer, purchase by the seller, purchased by the customer, right? Sale of goods, assets for cash or on credit if you are purchasing, right? So these are the business transactions. The second term is the capital. What is the capital? Capital, as we all know that when we need to start the business, what we need, the basic thing that we need is the capital, the amount, the fund, the finance, right? So the amount invested by the owner in the firm is known as capital. One more thing is that capital can be in the form of a cash or it can be in the form of the asset by the owner for the business entity, right? It is not mandatory for the proprietor to introduce capital in the form of cash only, right? So capital is also an obligation on the business, right? But it is an internal obligation, right? Because the business has to pay the capital to the owner, right? So it is therefore basically the capital is shown on the liability side of the balance sheet because it is an internal obligation of the business. The next term is the drawing. What is drawing? Withdrawal of money, right, from the business by the owner for the personal use, right? Am I repeating myself? Withdrawal of the business, right? If I am withdrawing, I have a business organization. If I am withdrawing some amount of money from the business organization for the purpose of my personal uses, so that particular sum of money is known as the drawing. Basically, drawings reduces the investment of the owner, right? Because it includes the personal expenses. Now, the next term is the liabilities. Liabilities are the obligations or the debts that the organization has to pay, right, at some time in the future. Basically, the amount payable to the owner is termed as the internal liability, that is owner's equity, that is capital. And the amount payable to the outsiders is termed as external liability, right? And on the basis of the duration, liability have been classified into two categories, non-current liability and current liability. Non-current liabilities are those liabilities which are usually payable after the period of 1 year, like long-term loans, debentures, right? These are also an obligation, but we need to pay these liabilities, we need to pay these debts, we need to pay these obligations after 1 year. In case of current liability, they are payable within the year, like creditors, bills payable. We'll also understand these terms further. The next important term of accounting is the assets. Assets are the economic resources, right, which have some value or that can be expressed in terms of value. Assets are the items of value used by the business in its operation. No business can survive without asset. Every business need an assets, right, to work, right? Assets can be land, assets can be your building in which you are conducting your business, assets can be factory where the production is going on, assets can be the furniture owned by the business enterprise, assets can be the stock, assets can be the cash, assets can be the equipment, right? Basically, assets have also been classified into two categories: non-current assets and current assets. Non-current assets are those assets which are held for long-term purpose in the business, right? Or that long-term duration is what? More than 1 year, we can say. Current assets are those assets which are held by the business for the purpose of converting them into the cash within 1 year. So there is also the stipulated duration of 1 year. The assets which are surviving, which are been retained in the business for more than 1 year, that are non-current assets, and which are not retaining in the business, going to retain in the business for 1 year. This is current asset, right? And it have the further classification. Okay, then the next term is the expenditure. What is expenditure? Expenditures refers to the amount spent or liability incurred for acquiring any asset, acquiring any goods or services, right? Basically, like we can take example of the expenditure like payment of rent, payment for the purchase of land, purchase of machinery, right? Expenditures have been classified into two categories: capital expenditures and revenue expenditures. Capital expenditures are those expenditures which are incurred for acquiring or increasing the value of the fixed assets, right? And the benefit of the capital expenditure we can attain over a long period of time, and they are shown on the asset side of the balance sheet. But when we talk about the revenue expenditure, they are the expenditures incurred during an accounting period and the benefit of which we are going to attain in the current year only, right? So these are the revenue expenditure. And one more thing is to be taken into consideration, that revenue expenditures does not increase the earning capacity of the business, but they are incurred to maintain the earning capacity. Okay, this is a very major difference between the capital expenditure and revenue expenditure. Now the next term is the expense. Basically, expenses are the cost incurred by the business in the process of earning revenue. Like we are paying salaries, we are paying wages, we are paying rent. Generally, what happens? Expenses are measured by the cost of asset consumed or services used during an accounting period, right? Like cash payments, decrease in the value of fixed asset in the form of depreciation, right? These are debited to the profit and loss account. The next term is the income. Income is the surplus of revenue over the expenses. Revenue is the amount we have generated from the sale, and expenses we get to know what are expenses, right? So income is the surplus. When the revenues are more and expenses are less, so the difference between the revenue and expenses termed as the income. The next term which we have to cover is the profit. Profit is the excess of total revenue over the total expenses, right? In the business enterprise for an accounting period. Profit has been classified into two categories: gross profit or gross loss, net profit or net loss. Basically, gross profit is the difference between the sales revenue over the cost of goods sold, right? And net profit is the profit earned after subtracting all kind of expenses, whether operating expenses or non-operating expenses, right? The next term which we have to cover is the gain. Gain is the monetary benefit, basically the profit or advantages that arises from the transactions which are incidental to business. Right, profit is of regular nature, but when we talk about gain are of irregular nature. We are not going to gain anything in a business on a regular basis. We are not going to earn gain on a recurring basis. This is the major difference between the profit and the gain. Profit is also income, gain is also income. But profit arises due to the operating activities and it is of recurring nature. But gain is not the income which is of recurring nature. We are going to earn the gain on non-recurring basis, or this is of very irregular nature. The next important term is the purchases. Purchases refers to the amount of goods bought by the business for the purpose of resale either, or for the purpose of use in the production. When we talk about the trading concern where buying and selling took place, in that case purchases are made for the resale because it can be with processing or it can be without processing. But when we talk about the manufacturing concern where manufacture process is going on, raw materials are purchased and processed further into the finished goods and then sold, right? And purchases included both cash purchases and credit purchases, right? When I talk about purchases, it can be cash as well as credit. The next term is the sales. Basically, sales are the amount, right? Or the sales are the amount of goods sold, right? That have been already bought or that have been manufactured by the business, right? Sales also include credit or cash. Then the next term is the goods. Goods refers to the products in which the business unit is dealing, right? Goods means all the items which are purchased and sold in an ordinary course of business. In an ordinary course of business mean we are purchasing and selling the goods on a regular basis, right? This is an operating activity of the business, right? For example, for a furniture dealer, purchase of chairs, purchase of tables, purchase of almirah is the good, right? Is the termed as a good. While for others, it can be termed as an asset. But for the furniture dealer, these item of furniture are termed as the good because that particular person is dealing in that product, right? Then we can take the another term that is stock. Very important term. Stock is also an asset. Stock is also named as inventory, right? Stock or inventory means what? Means the goods which we have covered earlier. Goods held by the business for sale in the ordinary course of business, right? The goods which we have kept with us to sell further. They are the stock. Stock may be opening stock. Opening stock means the unsold stock in the beginning of the year. Stock can be closing stock, mean unsold stock at the end of the year, right? Stock is basically the tangible asset for the business or current asset also. Stock can be of three types. Stock can be of raw material, stock of semi-finished goods, which is also known as stock of raw material, stock of finished goods, right? The stock of finished goods means the product which has already been completely made, right? So stock can be of three type and stock can be of closing and opening as well. They are the current assets. Now the debtors. When we sold something to the customers on credit basis, then the debtors arises. Debtors are the person or debtors can be the firm to whom goods have been sold and services have been rendered on credit basis. Please mind it, on credit, and payment has not been received, right? The amount due is known as debt and the person or the firm is known as the debtor, and this is treated as asset, right? These are the assets and they are shown on the asset side of the balance sheet, right? Then the second next term is the creditor. Creditors basically arises due to the credit purchases, right? Creditors are the person, creditors can be the firm as well, from whom goods have been purchased. We have purchased the goods or we have received the services for which we have not made payment, right? So we become the creditors, right? The creditors are shown as the liability in the balance sheet because we have to pay to that person, na? Because we have purchased something on credit, so we are liable to pay, right? So they have become the creditors for us, we need to pay them, right? The next term is the voucher. Vouchers are nothing but the evidence of transaction that the particular transaction has taken place in the organization. How do we come to know? We come to know by the help of the vouchers. Vouchers are also the source document or we can say the evidence of the business transaction which took place in a business, right? For example, if we buy goods for cash, we get cash memo. But if we buy goods on credit, we get an invoice. And when we make payment, we get a receipt and so on. So these are working as a vouchers or these are working as a source document evidence of any transaction taken place in the business. Then the last term, important accounting term that we need to cover is the discount. Discount is the deduction in the price of the goods sold. Discount can be of two types, trade discount as well as cash discount. Trade discount is given by the manufacturers to wholesalers or wholesalers to retailers to enhance the sales, to increase the sales, to increase the revenue. And cash discount is given when the we encourage the debtors to make prompt payments, right? Cash discount has nothing to do with the increasing revenue, right? Trade discount is not recorded in the books. However, it is being calculated on the sales, but it will not be recorded in the books, which we will cover in the further chapters. And cash discount is always recorded in the books of both the parties. This is the basic difference between the trade discount and the cash discount. So we are done with the basic accounting terms in this video.